And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
And it's time to say good afternoon to Luke Smith once again. How quickly does Friday come around?
It feels like I'm here every other day at the moment, which I'm not sure it's a good or a bad thing, but we have a laugh.
This time last week, it was the eve of the election. A lot has changed since then, hasn't it?
Isn't that a sad state of affairs? Yeah, let's not spoil a beautiful Friday afternoon talking about who won that.
Well, I did kind of want to touch on a couple of things from that. No, I know we're going to go into how much can you get into your super this year now that the limits have changed. But there are a couple of things going on. First of all, it is still the government's policy to impose tax on unrealised capital gains inside super with some limits, but we spoke about that a little bit last week.
Yes.
Now that's very definitely a real prospect.
Yeah, it's quite frightening, isn't it? But again, people need to keep in mind there that we're talking about $3 million in super, and to clarify those out there sweating it, it's $3 million per member account. So it's $6 million for a couple in a super fund, which actually affects a very, very small portion of the broader population. So whilst I think it's a disgusting piece of legislation, not because of what they're proposing, I'm not against people paying tax because you're uber rich, and again, I'm not got nothing against the uber rich, but my concern, as we spoke about the other week, was, well, where does this leak into then into other areas? That's my concern of where they apply it to. When you actually look at who will be affected by this legislation on an additional 15% tax over 3 million, the actual numbers are minuscule when you look at the broader population.
The concern that some people have, though, is that it's not going to be indexed over time, so gradually more and more people will reach the threshold. Yeah. And if they get away with doing this, then they might seek to tax unrealised gains elsewhere as well.
Exactly, and that's my concern. Because this piece of legislation, Div 296, they're calling it, has been around for quite a while. It's not a new proposal. The other big thing that they've been battling with is how do you bring into play the defined benefit pensions and the impact of that when you're talking about total super balance? Because for all of the people in the ACT especially, you've retired, you've got a pension from CSS, PSS, DFRDB or MSBS. Let's say it's a $100,000 pension. That's $1.6 million of your $3 million. And now you could have a significant super balance and be over the $3 million cap, but how do they tax the implications of the pension because it's non-commutable? So that's been a point of contention for them as to how they measure and tax it. But again, it's the concern of where it leaks to.
Yeah.
Your average Australian, your very wealthy Australian actually shouldn't be too concerned about it because $3 million in an individual member account in superannuation is
unusual,
pretty rarefied air. And now it's almost impossible to achieve because of the contribution rates that are in place. Unless you've invested in something in, say, a self-managed super fund and then you've sold the shares in whatever you owned to Google, or you bought crypto 15 years ago, it's going to be very difficult in the short term for people to breach through that cap, but it's quite concerning.
It is. The other issue that has arisen in the wake of the election is that National Seniors and Council on the Ageing are both calling on the government to extend the ongoing freeze on deeming rates, which apparently is due to come to an end at the 30th of June, I think. So what's the deal with deeming rates?
So what they did was they reduced the deeming rates when cash rates were very low because retirees, generally speaking, had a lot of bank deposits and they were deeming an assumed rate of income for their Centrelink benefits that was greater than the actual amount of income that they could earn at the time because we saw a decade of very low interest rates. So they kept them, they adjusted them and kept them very, very low. And now they're proposing that they bring back or increase the deeming rates, which is the assumed rate of return on the money that you have invested either inside or outside of super that goes towards your calculation for the income test as part of your Centrelink assessment for the age pension.
All right, so time will tell whether or not the pleas of National Seniors and Council on the Ageing are actually heard by the government, but time is running out on that one. Meanwhile, as I indicated before, our topic today, how much can you get into super this year now that the limits have changed?
Yes.
What, the limits have changed? When did that happen?
Again, well, they haven't changed yet, and that's why I'm raising it, because your Total super balance is a measure of the total value of superannuation assets that you have. That includes accumulated superannuation, pension accounts, as well as a lump sum value of a defined benefit income stream. As I said just before in that previous example, you've got a $100,000 CSS pension, you multiply it by 16 and you were given a value when you received that pension, and that figure is set for the life of that pension because it was assessed under the transfer balance cap in 2017. The reason that they are bringing this to light is your ability to make a contribution in the next financial year is set by your total super balance at 30 June every 12 months. So your balance in 7 weeks will determine your eligibility to make a contribution in the next financial year. So I want people to be thinking, hey, what does this do for me? Because the total super balance at the moment is 1.9 million. It is moving to 2 million on the 1st of July. So you could have had, for example, a balance in your superannuation that was over 1.9 million, and you could not add a non-concessional contribution or tax-free money to super. Now, people might want to add money to super to reduce tax in their own name. They might have inherited a windfall. They want to add it to their pension. There's a raft of things that you may want to do. Another really good strategy to consider here is resetting the taxable and tax-free components, which we've spoken about in previous shows, to lower the estate tax incurred when you die on the taxable portion of your superannuation. Now, I raise this because you need time to work this out. You need to consider your total super balance leading into 30 June. Where it is under $2 million, you will be able to put in $120,000 in July in the next financial year. At the moment, if you have superannuation of less than 1.66 million, you can do the full 3 years of 120,000, which is 360,000 into super. But as you move up the bands, the closer you get to 1.9 million at the moment, the less you can put in. And a lot of people get caught because they go, oh, I haven't put any money into super. I can do that 3-year thing and put in 360. And I preface that by saying, well, how much was your super at 30 June last year? Because if you were at 1.8 million, then you can only do 120,000. So we're raising that at the moment to get people to look, because a lot can happen in 12 months, or you may have the money outside, you may have sold an investment property, you may have done a number of things, and you want to get some money in because you may want to reduce assessable tax by adding to superannuation. And if you can start a pension, great. If you can't, tax in superannuation at 15% might be lower than your marginal tax rate. So you need to look and say, right, what is my balance likely to be and where will it fit on a sliding scale? Now, there's a lot of numbers for radio, but less than 1.76 million at 30 June, you can put in 360,000 next year. If you're between 1.7 and 1.88, it's 240,000. So you can see as we move up the bands, as we get closer to 2 million, you've got less capacity to add the money. But this change, whilst it's only $100,000 from 1.9 to 2 million, it could be, $120,000 of tax-free money that you can add to super. Now, if you're over, let's say you're over that 2 million mark by a little bit, I'd be thinking about pulling out, as I said to a lady yesterday, if you pull out 20 and we're at 1.98, you could put 120 in on the 1st of July. You can get an extra 100 in by pulling out 20. So I wanted to give people, a bit of lead time so that they can think about where their balance is at. We've seen markets come back of late, which could be good because last year markets were very strong and values were very, very high. We've seen Trump adjust some of the balances of our super.
Indeed we have.
And here's a positive to, something Trump's done lately, which is rare. He might have accidentally given you the capacity to add more money in. And now I also want to explain to people that don't get total super balance and transfer balance cap muddled up, right? They are very different. Total super balance is your ability to make a tax-free contribution to super. Transfer balance cap is your ability to start a tax-free pension, right? Two very, very different things, but at the moment, the balances are the same. Okay, so people need to keep that in mind. Transfer balance cap is 1.9, total super balance is 1.9. But that doesn't mean that your transfer balance cap is 1.9 million, because it depends on when you started a pension. So it's important people understand, can I put it in before they worry about whether or not they can start a pension? But I find a lot of people jam those two terms together but don't understand what they measure and how they can be used.
Well, that's natural and easy to understand, isn't it? Because the threshold figure is the same amount for both.
Exactly, and people lump them both in the same bucket and say, oh, but I'm over my transfer balance cap, I can't add to super. Yes, you can. It depends on what the number is for that test. So this is a really, really good opportunity because it's been a while since that rate was increased. It started at 1.6, it went to 1.7, then we had a number of years, then it went to 1.9. Now it's gone to 2 million. So use this strategically to reset the taxable components for your kids, add some non-superannuation capital because your tax rate in super may be less than in your own name. Use it as a way to equalise balances between spouses. And think about trying to get under that 2 million number or under the threshold, which you can easily Google, see where you sit on that sliding scale. Because if you took a little bit out, you might be able to make an even bigger contribution next year or reset $240,000 of benefit and save your kids, $34,000 of tax, which your kids won't be upset about.
Today we're talking about how much can you squeeze into your super this year now that the limits are changing. So, Luke, we've covered a bit of territory today. What are the important points for people to keep in mind?
Well, I think you've got to work on your backswing first. Oh, sorry.
You're thinking about that golf game tomorrow.
I wish. Look, check your balances. Understand where you're at. If you've got multiple funds, add them together and keep track of how close you are to the relevant balance that will be applicable to you. If you're not sure what the thresholds are, just Google total super balance 2025 and there'll be 100 links pop up. You can click on just about any of them and they will have a table showing where you fit within the bands that then determine whether you can put in 360,000, 240,000, 120,000. So look at your balance. Get under the closest band you can by being strategic and maybe taking out a little bit of money so that you can put more money in the next financial year. Remember that total super balance and transfer balance cap measure different things. Don't let one influence your decision with the other because they are like apples and oranges when it comes to their application. Adding money to superannuation could lower tax in your own name. So if you have cash, a couple of investment properties and some super, look to try and get some money into superannuation because you may or may not be able to start a pension. Think about making a spouse contribution like into a spouse's super fund if they have space. You might even bring the balance of yours down, add money into a spouse's superannuation fund so you can add more cash into yours. So really start thinking holistically about this change because it is a wonderful opportunity to limit the amount of income tax that you're paying. Make sure that you don't just assume that you can do 360. I guess that's what a really big one I want people to take is I have a lot of people come in and go, well, I'm going to throw in 360,000 in July. I go, well, hang on. How much super do you have? Oh, does that matter? It really does. And then remember that the total super balance does not preclude you from making deductible contributions. That's another one I get all the time. I'm over 1.9 million. I can't put deductible contributions in. Yes, you can, provided you meet the eligibility to make the contribution itself, which is under 67 and not working, or over 67 and have met the work test prior to 75. You can put $30,000 into super. So think about this in conjunction with non-concessional. You might get your balance under 1.8 million, put in 240,000 and then put in 30,000 of deductibles where you would benefit in your situation to a tax deduction. So think strategically between yourself and a spouse, if you have one. Think strategically about your super and what you can do. But be informed about where you sit leading into 30 June in relation to your total super balance.
Which raises, of course, a whole other question, which is going to be a discussion for another day. What's the difference between deductible and non-deductible contributions? Maybe we'll pencil that in for a future time.
I'll stick that one in for next week.
Thanks very much. Now, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the strategy stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, so you can subscribe to that and get an entire back catalogue of shows that you can watch on your phone or your tablet. And all of these things are in Smart Money Strategy, your ultimate guide to financial planning in all good and bad bookstores and online.
Absolutely. And Mother's Day this weekend. Rush out and grab one tomorrow morning.
100%.
Luke, thanks very much.
See you next week.